What's up, guys? So it's officially now time for the first ever African Forex movement session. So, guys, as much as I wanted to make this a long video, unfortunately, I can't simply because the application I'm using, which is Zoom, doesn't allow me to record videos more than I think 1 hour, something like that. So I need premium, and I am teaching you guys free. So you must remember that. So it would have been much easier if um what do you call this? You guys paid a subscription, and I was able to pay for the Zoom subscription so that we can make long videos whereby you guys can ask me questions and everything like that. But at the moment we'll be using what we have. So this video I'm gonna be uploading on Telegram. So yeah, this is the first ever session. So let's get into it, guys. Uh so first of all, trading, one thing you must know before we get into anything is that, guys, trading in the forex market possesses a high risk to one's capital. And believe me when I say that I've blown many accounts trading, guys. Um, and for those who are going to risk money for rent or something like that, guys, please don't risk money you're not willing to use. Use the money you are going to go out, like the money you are going to groove with during the weekend. Use that money instead, because whether or not you lose that money, that doesn't matter because you were gonna waste it on alcohol anyways. So guys, basically, guys, don't risk money you can't afford to lose, guys. um Me, when I'm trading, I trade with money I afford to lose. I trade with money I was gonna use with unnecessary expenses, guys. So basically, don't trade with money you can't afford to lose, guys, because as you can see right here in the disclaimer, the intelligent investor knows not to risk capital he or she is not willing to lose. As crazy as it may sound, guys, because forex trading is like any other business, guys, whereby you put your money in not knowing whether or not you're gonna make a profit. You see, guys. So for those who say forex trading is gambling, guys, forex trading and gambling is two different things. That's the same as saying investing and gambling is the same thing, guys. Guys, I'm not sure how I'm gonna explain this to you, but as time goes by, I will raise this point again and explain to you why I say forex trading is not gambling. So basically, forex trading is not gambling because one who makes a profit trading in the forex market possesses knowledge. Because, guys, you can't put your money in something you don't even know. You must first learn what's going on here before you place a buy, before you place a sell, and make a profit. So, an intelligent investor knows, or intelligent investor who makes a profit trading in the forex possesses high knowledge, understands market structure, which is things we're gonna be going over, and is psychologically fit, as the forex market can either make you or break you. Guys, believe me, believe it or not, guys, forex trading is not for the faint-hearted, guys. It's not for the faint-hearted. You'll see why I'm saying all these things, guys. And lastly, for African forex movement will not be held liable for any occurring losses, guys, you encounter, as we only in giving investment advices, guys. When I place a buy, I'm gonna tell you guys, I'm placing a buy on whatever asset I'm placing a buy in. And you guys, what's going to happen is you guys are gonna it's gonna be up to you whether or not you buy when I buy. Don't take it as a signal as me telling you buy, place a buy. No, guys, I don't want to be held accountable for anyone's money being lost in the forex market. So, let's get into it. Let's get into it, guys. Let's get into it. This is book one of five, as you can see, guys. I haven't published, rather, I haven't typed the other books yet, simply because I want to receive your guys' feedback and hear from you. Like, do you understand what I'm explaining to you and stuff like that, guys? So this is one quote, one of my favorite quotes. I'm not sure who it's from, but these are one of my favorite quotes. Chase pips, not money. The money will follow. That's for sure. I know you guys will have no clue what this means, but as time goes by, and as I teach you and introduce you to everything that I know in the forex market, you'll understand what this means, guys. Anyways, let's start with the introduction. So right now, guys, you're probably asking yourself, please excuse the rotation. I'm using my cell phone, guys, because I haven't what do you call this? I haven't downloaded Zoom on my PC. However, right now you're probably asking yourself, what is Forex? Well, Forex, short for foreign exchange, is a 24-hour, 5 days a week global market which operates from Monday to Friday, um, at 12 a.m. on Monday to 11 p.m. on Friday, I think. But you're gonna see the times, guys. Um, However, the times are not important. But like as I was saying, it's a global market where currencies are exchanged. And I know you're asking yourself how a currency is exchanged and also who is exchanging these currencies. Anyways, guys, a quick fact about the foreign exchange market. The foreign exchange market, guys, is the world's biggest market, whereby an average of $2.2 trillion circulates daily. So from Monday to Friday, 2.2 trillion is circulating in the forex market. So guys, one thing I must tell you is that there's enough money for everyone in the forex market, guys. There's enough money for everyone in the forex market. So without that, let me dissect this for you all and let me explain how currencies are exchanged exactly. How currencies are exchanged in the foreign exchange market. So Um, well, Forex typically is the means by which individuals, companies, and central banks, not only mentioned above, there are many more. Anyways, what they do is they convert one currency into another simply because most currencies use their own unique currencies. I'll explain why. So, guys, for example, in South Africa, we don't use the dollar, we use the rand. In Nigeria, they don't use the rand, they use the Nigerian naira, whereby, guys, we have our own currencies. As it's like, what do you call this? In soccer, guys, each team has their specific kit. If, for example, Real Madrid has a white, what do you call this, home kit, Barcelona has a, what do you call, red and blue home kit. So it's the same like that, because Real Madrid likes the color white, and not only because they like the color white, their logo or something like that has the color white and stuff like that. So that's the same with currencies, guys. When it comes to countries, we have our own currency because we have our own unique what do you call this, economy and stuff like that. So um that's why we use, but I'll explain further on the second slide. um One thing you must know, guys, though, one of the most recognized currencies is the United States dollar, guys. I'm sure you know that by now. Anyways, exactly what I said in the previous slide. So the reason each and every country uses their own unique currency is because countries have their own unique economic situations and want to make monetary decisions based on their specific interests and needs. So basically, guys, monetary is relating to money and currency, stuff like that. So we can't use the United States dollar. Let's say, for example, the United States dollar has a picture of the United States president, and in South Africa, we have to have our own unique currency, and that's why we have our own president in our own currencies. So, guys, basically, I would say currencies, guys, it wouldn't be fair for us, for the world to use the same currency, guys, because for example, right here, uh so in order to determine a currency's value, basically we look at its economic situation, guys. Now, a country's economic situation consists of the economic indicators such as the GDP, the unemployment rates, and many more macroeconomic indicators of that specific country. So basically, guys, to make an example, um, let me do this. Uh, Let's make an example between South Africa and the United States, guys. Let me make an example between the two. So we all know that the United States is a more advanced country than South Africa. We all know that because besides that, they are economic indicators. Economic indicators are anything that involves the economy of the country. So the means of unemployment rates, GDP. GDP is basically the gross domestic product, basically how much circulates in the economy. Um, the the GDP growth, basically how much the economy grows annually or monthly, basically. And the means of interest rates, how much the banks are charging you, how much interest the banks are charging you for loans and stuff like that, and the inflation. All of those have impact to a country's currency, guys. For example, let's compare the two, right? The unemployment rate in South Africa, for the whole country, is 32%, meaning that out of the whole people, out of everyone in South Africa, 32% of the people are not employed, meaning that plus minus 68%, only 68% of the people in South Africa are working. And what that should tell you is that with less people working, there will be less money circulating in the economy because there's a high number of people who are unemployed, who are not contributing to the economy, helping businesses by buying because they don't have money. They are unemployed. So when we look at the unemployment rate for the United States, we can basically see that the unemployment rate is 3.9%, which is almost 4%, meaning that plus minus 64% of the, to be exact, 64.10% of the economy No, no, not 64. 94%. 94% of the civilization in the United States is employed. Only 4%. No, it's 96% actually. So only 4% of the people, the whole United States, only 4% are not employed. Meaning that when we compare the unemployment rates with South Africa to the United States, a greater number of people are unemployed in South Africa, meaning that the money that circulates in the South African economy is going to be less than the money circulating in the United States economy, whereby more people are employed, more people are buying in businesses, more people are buying everything, guys. So, with that being said, the more people are buying, the more government is gonna make money in taxes as everyone can afford, everyone is buying, everyone is being taxed. And with the government receiving enough taxes, that means government is gonna make sure um that economy is stable. And guys, basically what I'm trying to say is if an economy is making much more money, if a country is making much more money than another country, that country's currency is going to be more valuable than the currency of the country that the people are whereby it has a higher number of unemployed people, basically. So, um, as I said, guys, in order to determine a country's currency value, we look at its economic situation. Um, the likes of the GDP, unemployment rates, and many more other macroeconomic indicators. That's what we call them. Um, in the Forex market, we call them macroeconomic indicators. Anyways, now a thing you must understand as a trader is that whenever you see a country has a more advanced productive economy than the other, for example, the country comparison between South Africa and the United States, whereas the United States has a more developed economy because less people are unemployed and there's more money circulating in the economy. As you can compare the two, $420 billion is circulating in South Africa annually, and compared to the United States, whereby $23.32 trillion is circulating in their economy annually, which should tell you that more people are employed, they are spending, more money is circulating in the economy, as I explained, guys. So, the more developed economy, now because of that, its currency will be more valuable no matter what, because a currency's strength is determined by the local and international factors such as demand and supply in the foreign exchange markets, the interest rates of the central banks, as I explained. Interest rates that are set by banks is also very important in the foreign exchange market. I'll explain why further in when we go into details and stuff, guys. The inflation and growth in the domestic economy, basically in macroeconomics, as I said before, anything that involves interest rates, inflation, GDP, those are all categorized under macroeconomics in the foreign exchange concept. Now, with the example provided in the previous slide, where we can clearly see that the United States has an economy that is way more advanced than the South African economy. As you can see, only 4% is unemployed in the United States compared to South Africa, where by 32% of people are unemployed, meaning that there are less people spending money because they don't have money, they are not working, they're unemployed. So we can clearly see that the United States has an economy way more advanced than the South African economy. That's why when we take 1 rand, 1 South African rand, to the United States and ask them to convert it to their currency, it's only going to be 5 cents because of our economic value. Um, Now, given that information, that simply tells us that it would be impossible for South African rand to be more valuable than $1 American, which is why 1 South African rand is only 5 United States cents. So the reason why the South African is weak against the US dollar is because, as I explained, guys, in simple terms, I'm gonna be place it like this: the US dollar, the rand is weak against the dollar because the US economy is more valuable than the South African economy. To put it in simple plain English, that's why whereby we take the currency from the developed economy, the United States, the country that is developed. We take one United States and exchange it here in South Africa. We are going to receive 19 South African rands. This is a, what do you call this? A screenshot from the 19th of March 2024. The dollar has changed obviously by now, but this is just an example I'm making. Now, as you can see, because of the economy valuation, you must pay 19 South African rands for the US dollar, whereas 1 South African rand is only valued at 5 United cents. So, for those, if you guys don't understand exactly like, or don't quite like hear what I'm saying, you guys are absolutely free to text me. You can text me and ask me in the video. I don't understand whatever you said, and I'll reply as soon as possible, guys. Now, to explain exactly how individuals and companies and central banks all around the world participate in Forex, it's pretty quite simple actually. Even you reading this right now might have participated in foreign exchange without you knowing. So I'm gonna make a scenario in order for you to get some type of understanding. So in the first scenario, let's use the United States of America. So let's say I'm here in South Africa and decide to go to the USA for some reason. Now, firstly, I start by looking up on the internet how much the rand, which is our local currency, is trading against the United States dollar, which is the currency used at the country I want to go to. So now let's say we get our search results, and let's say at the time we find out $1 is valued at 15 rand. Because one thing you must know, guys, is that each and every currency doesn't stay at the same value. Because one thing I'm gonna tell you is that the actions of humans affect the market, guys. For example, if the unemployment rate, let's go back, if the unemployment rate in the United States were to go up to 50%, and meaning that half of the population in America is unemployed, which is more than South Africa's unemployment rate, as South Africa's unemployment rate is 32%. The value of the dollar would decrease, and the value of the rand would increase, simply because of simply because of human actions, guys. What I said before, um if the unemployment rate were to go up, in the United States, the value of the dollar would go down in the foreign exchange market simply because whatever happens in the forex market is because of real life actions, guys. For example, GDPs, unemployment rates, interest rates, all of those affect the market. That's why the value of a currency doesn't stay the same, guys. People are constantly getting employed, unemployed, employed, unemployed, just like that. Anyways, so let's say we get our search results and find out the dollar is at 15 rand. So basically, for $1 American, we have to pay 15 rand. Now, with that information, I decide it's time to pack my bags and proceed to the airport, where I arrive at the airport and I decide I'm going to get $100 cash, guys. So now, since $1 is 15 rand, I have to exchange 1,500 for $100 because um for every 15 rand I'm getting $1, which is $100, guys. So now we arrive at the USA and we decide to pay all our expenses via card, meaning that we don't use the $100 that we paid 1,500 rand for because of the value of the dollar was 15 rand at the time. So basically, what happens is that um, when time goes when time goes by, it now arrives time whereby I have to go back. We take off. When I arrive at the South African airport, I decide to keep the $100 as a souvenir instead of exchanging it back and getting my 1,500 rand back because we can't use United States dollars in South Africa because we use the rand. Same applies if I arrive with 5,000 rand in the United States. There's no shop that's gonna accept my money because they have their own currency in that country. So let's say a week goes by after we've arrived back from the United States, and let's just say the $100 in our possession, we still have it, right? However, we can't use it in South Africa. As you may know, we use the rand, which is our local main currency. Now, because of financial reasons, let's say I decide it's time to let go of this $100 that I've kept in my possession for plus minus 2 weeks. Now, remember, guys, I kept $100 that I paid 1,500 rand for, and I received $100, right? And as I explained before, the currency of a country doesn't stay the same, guys, because anything can happen. Tomorrow, the United States has employed 500,000 people, whereby let's say the unemployment rate can go down to 2%. We never know, guys. Meaning that if the unemployment rate goes down, the value of the currency is going to go up because more people are employed, meaning that more people are spending money, more money is circulating in the economy. You see, guys. So let's say I decide it's now time I give back this $100, even though, okay, let's say I have no clue that the value of the dollar goes up and down constantly. Now, let's say we arrive at the currency exchange establishment and hand the clerk the $100, guys. Now, to my surprise, let's say the clerk hands us 1,750, which is 250 rand more we paid than the 1,500 I exchanged for the $100 2 weeks ago. So basically, the why that happened is because of the exchange rate, guys. The exchange rate is basically the currency value constantly going up and down, up and down, up and down. It doesn't stay the same, guys. Now, you're probably asking yourself, now, why would the clerk hand you more than you paid before? So, guys, as I explained before, anything could have influenced the raise for the dollar. Now, there could have been a lot of factors that could contributed to the currency value raise. Factors that involve economic indicators, which I explained earlier, that whatever is happening in whatever country's economy, it has an impact on the future or current monetary decisions. Now, one economic indicator I know of that can increase a country's value is the release of interest rate decisions. Um, Now, you may be asking yourself, why does interest rates increase a country's value? Because, guys, high rates normally lead to an appreciation of the currency as foreign investors seek high returns and increase their demands for the currency through the exchange rate channel. Um, exports are reduced as they become more expensive, and imports rise as they become cheaper. So, guys, basically, interest rates make an economy makes an economy's currency appreciate simply because of, let's say, I go to the bank, right, and I tell them I want 100k, and they tell me that fine, we're gonna give you 100k, but our interest rates are 15%, meaning that let's say you're gonna pay 1,500 per month till you reach this 100k, compared to a country whereby their interest rate is 5%, whereby when I arrive at the bank, I'm gonna ask them how much I'm gonna pay. They're gonna tell me I'm gonna pay 5,000 rand, like stuff like that, guys. So I mean, not 5,000 rand, 500 rands per month, because their interest rates is lower than the 15%. So, guys, it's basically stuff like those, guys. So you may be asking yourself, why do banks increase and decrease interest rates? So central banks use interest rates decisions to control the currency value and navigate the economy towards the monetary policies goals such as low unemployment, high domestic product, and stable inflation rate. So basically, guys, um, one of the reasons they increase and decrease interest rates is because if they see that their GDP, let's say South African GDP is low, we're making less money than we made last year. I mean, less money circulated in the economy annually, like last year. So basically, what's gonna happen is that the banks are gonna decrease interest rates. Now, with low interest rates, they know investors are gonna take loans because investors know they're gonna be paying less, meaning that when investors take loans, they're gonna open businesses and stuff like that to employ people to decrease unemployment rate, basically, guys. So, guys, um for those who have questions, you are more than welcome to DM me and ask me, guys. In the group, I haven't closed the what do you call this? The allow to text. Anyone can text me and send me a message anytime. So, guys, we going to go to foreign exchange basics, but I want to make sure first whether or not everyone understands what I have just explained. So, guys, this is the first video. I'll be making part two when I get feedback from you guys. Anyways, yeah, thank you, guys. That's all for today.